Learning Outcome 2. Develop skills to identify and assess the risk profiles of organizations. Key lesson objectives. 2.1 Produce a risk profile for an organization. 2.2 Review and comment on risk profiles of organizations in different industries. 2.3 Discuss enterprise-wide risk and the benefits and drawbacks of such an approach. Risk profile of an organization. Risk profile is a summary that lists estimates for all the risks associated with a strategy, program, project, or activity. It is a quantitative analysis of the types of threats an organization, asset, project, or individual faces. The goal of a risk profile is to provide a non-subjective understanding of risk by assigning numerical values to variables representing different types of threats and the danger they pose. In finance, a risk profile can be a useful tool for discussing and evaluating a potential investment's ability to maximize return on investment, ROI, while minimizing risk. Risk profiles are documented and visualized using different methods but are typically based on estimates for the probability and impact of a list of identified risks. The risk profile is the aggregation of the total portfolio of risks the organization faces. Organizations can have hundreds of risks and thousands of controls, often having interrelationships with one another. As a result, filtering the most salient risks becomes challenging. The risk profile will outline the number of risks, type of risk and potential effects of risks. This outline allows a business to anticipate additional costs or disruption to operations. Also describes the willingness of a company to take risks and how those risks will affect the operational strategy of the company. The concept of risk profiling is not a new one. Its application is found in a wide range of disciplines from business risk management, such as financial and insurance, to medicine, including genetics, and science. Risk profiling has even been used to profile passengers in an attempt to use risk-based approaches to improve airport security. Usually, financial advisors and robo-advisors create the risk profile of investors by means of questionnaires. These questionnaires aim to fit the subjective risk appetite of an individual in numeric terms or any objective field. Also, they can contain choice-based questions or otherwise or both to adequately measure an individual's risk profile, as the respective financial advisor or institution sees fit. Nevertheless, any individual's risk profile should be a well-thought mixture of what they are aiming for, return-wise, and the amount they are willing to invest, plus the period for which they can maintain such investment. In the enterprise, the ability for a management team to understand and be able to measure gaps between the company's risk profile and its risk appetite is an important aspect of running a successful enterprise risk management program. A risk profile can include the risks that the entire organization must manage or only those that a particular function or part of the organization must address. Risk profiling is a systematic and structured approach to risk management which, if done correctly, should provide organizations with a detailed picture of all the risk elements of its operations, the effectiveness of the controls in place to mitigate the risks, as well as a framework for assurance and monitoring its higher risk priorities. Organizations' appetite for risk will differ considerably, and this may be partly a function of the size and complexity of the organization, driven by the operations and processes it conducts, as well as the culture of the organization. Some organizations may be willing to accept or retain risk, others may seek to implement risk management strategies to reduce or control, transfer or avoid risk. Every organization will have its own risk profile. This is the starting point for determining the health and safety issues facing the organization. In some organizations, the risk profile will consist of tangible and immediate safety hazards, while in others the risks may be longer-term health-related risks, and it may be a long time before illness becomes apparent. Clearly, some organizations, such as those in the construction industry, may have a mixture, spanning both immediate and chronic hazards. Improve risk profile. Below examples of improvements that are typically required in the way risks are identified within departments of an organization. Develop an overall integrated risk profile that covers the full range of risks, program and internal business risks. This concept is not always readily accepted where business risks are seen as secondary to the program risks. e.g., human health, safety, and the relationships between business and program risks are not always evident in the short term. Maintain and update an overall profile of the internal/external risks facing the organization, in the short and long term, and linkages with measures that are in place to mitigate these risks. The concept of maintaining/updating and prioritizing a list of risks is a straightforward one from a management perspective, but is often seen as being overly simplistic from a scientific, technical, or operational perspective. Be more explicit about the acceptable level of risk tolerance in each program/functional area, and review these with external stakeholders. Often, this information is available at the operational level, but is not well known at the senior management levels. Further, resources are typically not available to address those cases where risk levels are high, and resource allocation processes in departments must be made more flexible so that resources can be reallocated to the high-risk areas. Establish more formal process for prioritizing risks and organization-wide priorities at the Senior Executive Committee. Senior management needs to become more actively engaged and play a leadership role in prioritizing the risks, and making management decisions, e.g., resource allocations, based on the prioritization of risks. Enhance communications of organization-wide risks to staff and external stakeholders. This has longer-term implications in terms of training staff in risk management concepts, building risk profiling into strategic planning, monitoring risks as part of the performance measurement systems, and developing mechanisms to improve information sharing so that the information gets out to all staff. Continue to develop quantitative approaches to assess levels of hazards, risks, and probabilities. This also means establishing a more dedicated focus on environmental scanning and intelligence gathering, improving information sharing between departments, and identifying and defining competencies required to do risk profiling. Types of risk profiles. Broadly, the risk profile merits three distinctive types. Conservative risk profile refers to a significantly low-risk aptitude. Investors with this risk profile will lean towards investment options that provide the safety of the corpus more than anything. The scale of returns is a secondary factor to conservative investors as long as it is not negative. Typically, a conservative risk profile accounts for a short period horizon. Investment options most suited for conservative or low-risk takers are treasury bills, corporate bonds, sovereign bonds, debt-based mutual funds, etc. Moderate risk takers usually strive to strike a balance between returns and risk. These types of individuals will go for high returns scaled to an agreeable level of risk. Therefore, a moderate risk taker's portfolio will constitute a moderate share of equities with debt instruments for adequate risk dilution. Such risk takers can also singularly invest in equity-based mutual funds. Aggressive risk profile exhibits the most willingness for withstanding market volatilities and the expectation of earning exponential returns. Usually, these investors are seasoned and well conversant in the ways of stock markets. Apart from that, such investors also have a long-term investment horizon, which is why they can stomach the short-term volatilities. Contents and outcomes of risk profile. Contents. Outcomes. A summary of the key strategic and operational health and safety risks for an organization. The right risks have been identified and prioritized for action. Quantification of these risks, in terms of likelihood and potential impact. Minor risks will not be given too much priority. Identification of the current controls, their effectiveness, and improvement potential. The level of risk will be reduced to that which is acceptable. Identification of any controls not yet in place and any new, emerging risks with plans on how to deal with them. Paperwork and bureaucracy will be kept to the minimum necessary. A framework for monitoring and assurance, including a prioritized action plan with recommendations for improvements to address weaknesses with further controls and/or mitigation. Performance will be reviewed and lessons learned. Enterprise-wide risk management approach. In today's rapidly changing business environment, an ad hoc perspective and/or oversimplified assessment grid applied to the enterprise's risk exposures is inadequate. Robust approaches applied to different risk categories according to the underlying risk characteristics help identify the top risks within those categories. Those approaches should then feed management's consolidation process for formulating an enterprise-wide risk profile, merging the top risks in each risk category to provide a consolidated summary of the vital few critical risks. Applying analytical frameworks best suited to address the unique characteristics of the risks the company faces is an efficient and effective approach to integrating risk management with the core management processes of the business. By engaging the appropriate managers who are best positioned to own the risk assessments using analytical frameworks they understand and, most importantly, use, it increases the likelihood they will act on the assessment results. Enterprise-wide risk management, ERM, is a risk management concept that has evolved into an essential element of an organization's overall risk management practices. It is critical to an assessment of current and potential risks and the establishment of an organization's risk tolerance. ERM's primary objective is to identify, measure, monitor, and report on risk exposures on an ongoing basis. Its purview should encompass all on and off-balance sheet risks at entity-wide, portfolio, and business line levels. The ERM function should take into account the extent to which risks overlap or are interrelated. ERM is a process of coordinated risk management that places greater emphasis on cooperation among departments to manage an organization's range of risks as a whole. ERM offers a framework to effectively manage uncertainty, respond to risk, and exploit opportunities as they arise. The framework comprises of policies, processes, tools, reports, and ideal governance structure. The ERM approach differs from the traditional risk management approach as the focus is placed on an enterprise-wide strategy. Milebrook, 2002, argues that in order to achieve integrated risk management, a company must review and assess all the risks that could potentially affect its value. This core principle of ERM ensures that senior managers' focus is engaged on the uncertainties around the company's entire asset portfolio. ERM evaluates decisions made to accept a particular risk and assesses the aggregate level of risk in the institution in relation to the risk tolerance established by the board of directors. Effective ERM helps management achieve the regulated entity's performance and profitability targets and prevent loss of resources. ERM can also ensure appropriate reporting and compliance with laws and regulations, and avoid damage to the institution's reputation and associated consequences. What does a good ERM framework look like? 1. Risk governance. Committee. Structure and authority. Board and Board Risk Committee. Mandate and delegated. Holistic approach. Risk management philosophy and key principles. Link to strategic planning, capital and funding frameworks. Risk culture, values, and behaviors. Tone at the top. Reward and remuneration. Transparency and disclosure. Risk appetite statement. Key risks. Risk-bearing capacity. Risk tolerance and limits. Risk framework and key risk policies. Approve ERM framework. Risk policy framework and hierarchy. 2. Risk oversight and control function. CRO mandate and organization. Framework and policy oversight and maintenance. Stress testing and resilience. Model validation and approval. Review, challenge, reporting and escalation. Enterprise-wide view and aggregation. 3. Risk operating model. 3 lines of defense. Demarcation of roles and responsibilities. Independence and objectivity. 4. Risk management. Identification, assessment, measurement, response and mitigation, control and monitor. 5. Portfolio review, optimization and pricing, risk approval and underwriting, risk return and optimization. 6. Contingency planning and resilience, contingency planning, resilience testing, franchise protection. 7. Risk data aggregation, infrastructure, and reporting. Board and management reporting. Enterprise-wide view and aggregation. Common risk language / risk taxonomy. Bow and stressed. Benefits of effective ERM. Align risk appetite and strategy. Management should consider the institution's risk appetite, as established by the Board of Directors, in evaluating strategic alternatives, setting related objectives, establishing and defining risk tolerances, and developing mechanisms to manage related risks. Enhance risk response decisions. Effective ERM can provide the rigor to identify and select among alternative risk responses risk avoidance, reduction, sharing, and acceptance. Reduce operational surprises and losses. Institutions can gain enhanced capabilities to identify potential events and establish responses, reducing surprises and associated costs or losses. Identify and manage multiple and cross-enterprise risks. Every institution faces a myriad of risks affecting different parts of the organization. Effective ERM facilitates effective response to the interrelated effects and integrated responses to multiple risks. Improved compliance with legal, regulatory, and reporting requirements. To ensure compliance with regulations, one of the things that auditors look for is a company's ability to manage risk. With ERM, it is easy for regulators to determine whether an organization is strong enough to manage risks or not. Drawbacks of ERM. In an economy driven by positive return on investment, organizations often struggle to demonstrate sufficient ERM value to justify implementation costs. While traditional investment decisions are evaluated using common risk and reward metrics such as return on equity, ROE, return on assets, ROA, and risk-adjusted return on capital, ROIC, ERM value drivers are less prescriptive. Despite growing guidance, ERM remains largely voluntary, resulting in a value proposition void of compliance language and regulatory encouragement. An ERM program allows management to quantify the company's risks. As risk information becomes increasingly event-driven and dollar-based, company lawyers may raise issues regarding risk distribution to external regulators, auditors, and constituents. Organizations must balance risk visibility and legal exposure. One of the biggest challenges is establishing a consistent and commonly applied risk nomenclature. Any inconsistencies between risk definitions or methodologies are likely to jeopardize the program's success. Enterprise risk assessments are performed using a variety of approaches and tools, including surveys, interviews, and historical analysis. Each approach offers its own value and drawbacks that must be closely reviewed to determine organization suitability. The question regarding who should own ERM is often unclear and commonly disputed at the board, audit committee, and management levels. Lesson summary. In this lesson we have discussed risk profile of an organization mainly. You have obtained knowledge and understanding on risk profiles firstly. Further, types of risk profiles, contents and outcomes of risk profile 2 have been discussed. Enterprise-wide risk management, ERM, approach have been introduced towards the end of the lesson. We have identified the benefits and drawbacks of the ERM approach finally as well. Learning outcome 2, practice question. In order to recap this lesson, attempt the following task. 1. Briefly explain the risk profile of any chosen organization.